Brad Williams, Frugal Finance, forward rate agreement. A forward rate agreement is like working out a deal with someone about borrowing money at a fixed interest rate in the future. Here's how it works. Suppose you want to borrow money in the future, but you're concerned that interest rates might move higher before you actually borrow the money. On the other hand, someone else might be willing to lend you money, but they're concerned that interest rates might go down before you borrow. So you both agree on a fixed interest rate now for a future loan. This agreement protects you from interest rates going up and protects the lender from interest rates going down. Here are some key points. The agreement is cash settled, meaning no actual money is exchanged until the future date. The notional amount is the amount you're talking about borrowing, but you don't actually exchange it. The agreement has two main parts: the waiting period before the loan starts and the contract period when the loan is in effect. When the loan starts, one party pays the other based on whether the actual interest rate is higher or lower than the agreed rate. FRAs, we're going to use this a lot, FRA. So FRAs are like a way to lock in a borrowing or lending rate for the future, protecting both parties from changes in interest rates. What's a forward agreement? Forward rate agreement generally involves an over-the-counter agreement between two parties. In this arrangement, one party agrees to borrow while the other lends a specified amount at a predetermined interest rate known as the FRA agreement rate for a set period beginning on a mutually agreed future date. Forward rate agreement. Buyer, the borrower. Remember, buyer is the borrower of a forward rate agreement is short price and long interest rates. Just think about it. Buyer, borrower. Buyer, borrower. The association, so you're the borrower of a forward rate agreement, is short price and long interest rates. What does that mean? If you're short price and long interest rates, what happens if interest rates go higher? Your position becomes favorable. Higher rates, lower price. Interest rates go lower, your short position, the price increases, rates drop. Seller, the lender. So B, borrower, SL, seller, lender, of a forward rate agreement is long price and short interest rates. Why? Somebody was worried about higher interest rates. If they're short interest rates, if interest rates move higher, what happens? Their price drops. So they're worried about interest rates doing what? Buyer, the borrower of a future contract, is short interest rates and long price. Seller, the lender of a futures contract, is short price and long interest rates. A forward rate agreement is basically a forward starting loan, but without the exchange of the principal. The notional amount is simply used to calculate interest payments, enabling market participants to trade today at an interest rate that will be effective at some point in the future. Forward rate agreements allow them to hedge their interest rate exposure on future engagements. Concretely, the buyer of the forward rate agreement who locks in a borrowing rate will be protected against a rise in interest rate. If you're long interest, your price is going to drop, so you're short. So that's favorable. Any increase in interest rates, your price is going to drop. It's going to protect you because you're short. And the seller who obtains a fixed lending rate will be protected against a fall in interest rates. If the interest rates neither fall nor rise, nobody will benefit. Think about this for a second. The seller who obtains a fixed lending rate will be protected against a fall in interest rates. They're concerned about rising prices, higher prices, fixed rate, and be protected against fall in interest rates, lower interest rates. Why? Well, what happens? Let's say they're a lending institution and they have money coming in and they lend it at 8%. And interest rates drop. What happens? So now they have to somehow protect themselves against these lower rates. So will be affected at some point in the future. And the seller who obtains a fixed lending rate will be protected against the fall in interest rates. Because there's swaps available now, that's not a big concern. But in the past, savings and loans, they're married to long-term rates with short-term borrowings. What do I mean by that? By short-term inflows. They were stuck, let's say 8%. The only way banks make money is charging a rate higher than their borrowing rate. If interest rates drop, what's going to happen? They're exposed to, it's called duration risk. They're exposed to lower rates because now they can only lend at a rate lower, and then they have to subsidize that differential. I'll get into it later. Forward rate agreement buyer is long interest rates, rising interest rates. Forward rate agreement seller is short interest rates, falling interest rates. The lifespan of a forward rate agreement consists of two distinctive periods. The waiting period, known as the forward period, and the contract period. The waiting period generally extends until the beginning of the notional loan, typically lasting up to 12 months. However, durations of 6 months are more common. Meanwhile, the contract period encompasses the duration of the notional loan and can also be extended out to 12 months. We have a spot date, we have a trade date, we have a spot date, we have a waiting period, we have a fixing date, we have a settlement date, we have a contract period, and a maturity date. What are these key dates of forward rate agreement? The FRA ends upon the settlement date with no ongoing obligations between the parties once the settlement amount is paid out. The contract period is generally only used to calculate the settlement amount since forward rate agreements are off-balance sheet instruments. Forward rate agreement terminology listed below are the terms used for the different elements and events of a forward rate agreement. Contract rate, the negotiated interest rate the two contracting parties agree to on the trade date. This interest rate will be compared to the settlement rate when computing the settlement amount. It begins on the settlement date, D3, and ends on the maturity date, D4. Contract period, the period between the settlement date and the maturity date of the notional loan. The contract period can go up to 12 months. Currency, the currency to which the forward rate agreement notional amount is determined. Fixing date, this is the date where the reference rate is determined. That is, the rate to which the forward rate agreement rate is compared. Forward rate agreement buyer. The buyer of a forward rate agreement is the contracting party who borrows at the contract rate, forward rate agreement rate. Forward rate seller. The seller of a forward rate agreement is the contracting party that lends at the contract rate, the forward rate agreement rate. Master agreement. Generally, counterparties sign a master agreement between each other before entering into an OTC contract because doing so without a master agreement in place would mean mountains of paperwork having to be created and processed for each single deal. Maturity dates, the date on which the notional loan is deemed to expire. Notional amount, this is the notional sum for which the interest rate will be guaranteed and on which all interest calculations will be based. Reference table, the interest rate index to forward rate agreement rate will be compared against in order to determine the settlement amount. This will generally be a SO, and this is a secured overnight fixed rate type rate index with the same duration as the forward rate agreement. Contract period, for example, 6-month Euro LIBOR, Eurobor, for a forward rate agreement in euros with a 6-month contract period. Settlement amount, the dollar amount determined by subtracting the forward rate agreement rate from the reference rate, shown as a percentage of the agreed upon loan amount. One party pays this amount to the other party on the settlement date, which typically comes after the fixing date. Settlement date, the day when the agreed loan period officially begins and the settlement amount is paid. The spot date, the specific day when the forward rate agreement is executed, generally occurring 2 business days after the trade date. Trade date, the day when all parties involved negotiate and finalize the terms of the forward rate agreement. Waiting period, the period of time between the value date, D1, and the settlement date, D3. Yeah, a lot of moving parts into a forward rate agreement. Brad Williams, Frugal Finance. Thanks for watching.